Good afternoon. I am Dr. Thamara Bartholis, and welcome to Credit Reports and Credit Scores. Before we get started, let me go ahead and share my screen. That way you're able to see what we will be discussing. Okay. Okay, as I mentioned, welcome to Credit Report and Credit Score. I didn't have Credit Score on there, but as I put the presentation together, I noticed that credit scoring and credit score is one of the major factors that's important when it comes to credit reporting. But before we get started, let's go ahead and go over some housekeeping. First, all participants are in listen mode only, but please go ahead and use the Q&A box to type in your questions as I speak. Also, there are 3 sections to this presentation, so I will respond after to questions, if there are any questions, to anything that has been posted in the Q&A box. Okay, and finally, the webinar is being recorded and will be available for replay on our website and TU's YouTube channel. Okay, our agenda for today. First, we will cover what a credit report is, okay? We hear a lot about credit reports. Let's go ahead and define what a credit report is and what are the different aspects related to credit report. Second, credit score. What does it say about you when you see a credit score, or when a lender or anyone who pulls a copy of your credit looks at your credit score? And finally, what are some of the negative factors that affect your credit score? And some we may not even know affect our credit score. So we'll go ahead and review these things, these factors, to make sure we all understand everything that pertains to our credit. Okay. First section is credit report. Before I go ahead and get started, I would like, if you can go ahead in the Q&A box to answer our first question. One of the things I like doing is actually posing pop-up questions. And the first question is, what type of information can be found on your credit report? If you can go ahead in the Q&A box, enter your response, and I will go ahead and actually select the one that has the most response. Okay, let's see. Okay, so we have one answer. Okay, and I see that the answer is the first one. Unfortunately, that is not the answer. Let's go ahead and see if there are any other responses. Okay, so that is what we have right now, it seems. Okay, we have one last minute response, and let's see if that one is the correct response. You are correct. The information that can be found, among the information that can be found on a credit report, you will see your name, credit card payments, and student loans. Okay, let's go ahead and define a credit report. What is it? We hear a lot of people talking about credit report, and we also know that without a credit report, we cannot go ahead and access credit. So a credit report is defined as a document that contains our credit history. It really lets a lender know, even if it's not a lender, but whoever is accessing our credit report, it lets them know the following. First, what is our debt? How much debt do we owe? Second, what is our payment history? Third, what type of credit do we have? And finally, what is the recent credit inquiry that we've had? So the recent credit inquiry that we have means how many times have we actually applied for credit? So basically, it's letting our lenders know what type of behavior that we've had in the past that will let them know our likelihood of repayment or our likelihood of making the best of the opportunity that we have with the funds that they're giving us. Now, there are three national credit bureaus. Each credit bureau provides pretty much information regarding our borrowing patterns, as well as how long we've had credit, among many things. The three national credit bureaus are Equifax, Experian, and TransUnion. There are several others out there, but the three most popular and the national ones are those three. Now, what type of information will we find on our credit bureau credit report? The first information is this, our personal information, and that is pretty much verifying information. Where our name, our where we work, where we live, not so much the exact apartment number if you live in an apartment, but the address of where you live, as well as, consumer statements. Now, consumer statement is not something that we see often. A consumer statement usually lets a lender or whoever is accessing our credit report of information that we put on there that we want whoever is accessing our report to know. For example, if we were a victim of fraud, we can put on our credit report that we were a victim of fraud, therefore our credit score is what it is right now. Usually victims of fraud tend to have a lower credit score. Existing credit is another thing, and that is what our lenders tend to focus on a lot. They look at our credit history, our payment history, how long we have had the credit, and the patterns of payment that we've illustrated for the credit that we have. And also, public records. Public records are considered information that tend to be derogatory. For example, foreclosures, bankruptcies, collections, anything that we have borrowed funds for but have had trouble paying in after we've accessed the funds. And inquiries. Now, there are two types of inquiries, and inquiries are how many times we have actually, or not just ourselves, but individuals that we have said we would like to borrow funds from, how many times have they pulled our credit? So for example, I apply for a Discover credit card. If I apply for a Discover credit card, that will appear on my credit report. Now, and that's considered a hard inquiry. Now, if I myself say, you know what, I want to know what is on my credit report, and I go ahead and pull a copy of my own credit report, what will happen is it will show up as a soft inquiry. And a soft inquiry does not affect your credit score at all. Okay, now here's an example of a credit report. Okay, as I mentioned, the first part is our personal information, and that is what we consider to be verifying information. So the next time, whenever you apply to, not so much apply, but whenever you try to access your credit report, they will ask you some of this information to make sure that you are who you say you are. Okay, so you see on there your name, your address, and a lot of times, as I mentioned earlier, it doesn't have your apartment number, but it will have your date of birth, and it will even list your employers. Now, in terms of your address, it will have your address for up at least 2 years. So if you move within the last 6 months, that will not appear on your credit report. Next is the personal statement, and that is the information that I mentioned where if I was a victim of fraud or something happened and I wanted to let whoever accessed my credit report to know, that is where the information would be found, right underneath my personal information. The third section, as I mentioned, is the section most lenders tend to focus on, and that is the account summary. So the account summary lists every individual that we have borrowed money from. So, or whether it be a credit card or whether it be a personal loan where funds were given to you. So all of that information will be listed and you will see the account number. Now, normally the entire account number for that debt is not listed, okay? Usually the last 5 numbers or the last 4 numbers. And also you will see there where it says type. If it's a collections item, it will list as collections item. If it is not, you will see that the account is in good standing. It will also show the date that you took out the debt, or whether it be credit card or loan, and it will show the amount that you have actually used as well as the credit limit on the, if it is a credit card, the credit limit that is given to you. And that is how they can differentiate how much debt you've used, how much credit you've used compared to the limit that you've been given. Okay, now if it is just a loan that you were given, let's say, for example, a car loan, it will show how much you have paid of that car loan. Finally, actually inquiries. Inquiries, as I mentioned, how many times have you applied for credit? And as I mentioned earlier, that is considered a hard inquiry. A hard inquiry is when you sign your name on a dotted line and say, I would like to borrow money. Okay, soft inquiry, on the other hand, is when I myself or you say, I would like to actually access my credit report to see what is on my credit. And the last section you do not see on there is because not too many people have that, but you will see it, which is public record information. And as I said, as public record information is usually derogatory information, such as foreclosures, bankruptcies, and so forth. As students, chances are you would not see that information unless you started borrowing, early on. Okay, but if this is your first time accessing credit, or you've borrowed credit for 6 months, chances are you will not see public information on your credit report. Now, who can access your credit report? Since a lot of sensitive information is on your credit report, who can actually access it? Financial institutions, of course, if you're asking to borrow funds from the financial institution, they will say, I will need to access your credit report. And without it, credit will not be extended. Landlords will look at your credit report because chances are, if you do not pay, if you actually rented from a landlord before and had bad payment history, the landlord will report that. Usually landlords will not report it if you leave in good standing. But if for whatever reason you were 60, 90 days late, the landlord will put it on your credit report. Utility companies. Now, utility companies do not normally put information on your credit report, but utility companies will access your credit report to determine whether or not a deposit is needed. So if you look at your credit report and you're living in a rental home or an apartment, you will not see that on your credit report. You will not see PSO, you will not see the water company on your credit report unless you have defaulted on your payments. When you default on your payments, that is when you will see it on your credit report. But utility companies will pull your copy of your credit to determine, hey, can we extend service to this individual without that individual having to pay a deposit? So good credit matters. So if you have good credit, the deposit will be waived. Cell phone companies will determine whether or not the cell phone that you are wanting to purchase is something that they can expect payment from. It's for, especially if payments will be made in increments. So if your credit report or your credit score is low, chances are the only types of cell phone that can be given to you by the cell phone company will be prepaid cell phones or lower grade cell phones. State agencies. Let's say, for example, I am applying to be a mortgage broker or a mortgage lender. Chances are a copy of my credit report will be pulled because I will be given a professional license. And as a professional, especially in the financial industry, I must maintain a positive credit score. And employers. Employers can also, not all employers now, it really depends. I know for myself, after graduating from college, because my credit score was so low, a lot of people heard me tell this story before, but because my credit score was so low when I graduated, I was unable to secure the job that I wanted to secure. So make sure if you have credit, make sure you pay it on time, because employers will pull a copy of your credit to ensure that you are a responsible employee. Now, if you're wanting to access your credit report, you can actually access it through annualcreditreport.com. And it says that it will only offer or provide you with one credit report, but there are ways around that, okay? Now, how many times, answer in the Q&A box, how many times can you access your credit report for a free and from freeannualcredit.com? How many times can you access your a free credit report from annualcredit.com? Okay, I see 3, I see 2. Okay, anyone else? One more second. Okay, the answer is 3 times. And the way you can do that is, remember I said there are 3 national credit reporting agencies. There's actually more than 3, but the national ones that financial institutions use are Equifax, Experian, and TransUnion. So what you can do is 1 month you pull Equifax, 3 months later or 2 months later you can pull TransUnion, and then the following month or a few months later you can pull another one. Okay, so there are ways around it. Okay, you can also get a free copy of your credit report when the following happens. You've been denied credit. Let's say you applied for credit and you were told, we're sorry, but based on your credit score, we cannot extend credit to you. A lender has 60 days to make sure that you have that information, a copy of the denial letter letting you know the reason why you were denied. If you're applying for employment, remember I said an employer will actually pull a copy of your credit report. So if you are applying for employment, you can always say that when you go to freeannualcreditreport.com, you can let them know that I am applying for employment and therefore I would like to have a copy of my credit report. If you are a fraud victim, you automatically get a copy of your credit report. And also, if you are receiving public assistance, you can also receive a free copy of your credit report. Okay, let's see if there are any questions for the section covering credit reports. Okay. I do not see any questions, so I will proceed. Okay, now we will talk about credit score. The credit score is the actual part that lenders look at first. That's the first thing that pops out whenever we apply for a loan. Okay, they will see 780, 590, 650, And that usually gives them something to work with. Okay, that's usually their barometer. Okay, so before we proceed with credit reports, I have another question for you. Since there are 3 credit bureaus, they will each reflect the same credit score, true or false? False, false. Oh, okay. Very good. You all are pretty smart. Okay, that is true. And the reason for that is lenders will provide, lenders use a specific credit bureau. For example, one bank may use TransUnion and not really use Equifax and Experian. Another bank may use all 3 credit bureaus. So what happens is a lot of times you will see information on your credit report, one credit report, and another not really reflected on your information for another financial institution not reflected on your credit report. So it throws off the credit scoring sometimes. That's why a lot of lenders, they will pull a copy of your credit report and they'll have one credit score. And when you pull a copy of your credit report, you'll have a completely different credit score. So that is the reason why. Question number 2, which factor weighs more heavily on your credit score? The amount of debt owed, payment history, or number of credit inquiries? Okay, type your answer in the Q&A box. Okay, I see credit inquiries. Okay, I see credit inquiries. Anything else? Anyone else? I see inquiries. Okay, I see inquiries again. Anyone else? Amount of debt. Okay, amount of debt. And I see payment history. Okay, the answer is payment history. And we'll actually break down the different factors and how much each of them weigh on our credit score. Okay, which type of credit plays a key role in the length of credit history that we have? Which type of credit plays a key role in the length of credit history? Okay. Okay, I see revolving. Okay, any more answers? Okay, I see another revolving. Okay, one more second. Okay. Okay, since revolving received the most response, revolving is correct. Okay, and we will talk about that. Okay, the most common scoring models whenever we talk about credit score, it's always good to know which scoring agency, which scoring model is being used. The 2 most popular are FICO, which is the Fair Isaac Corporation, and Vantage score. FICO is used by 90% of lenders. So a lot of time when you or I apply for loans, we will actually get a FICO score, okay? Now, there are some agencies or some organizations, financial institutions who do use the Vantage score. Vantage score is fairly new. It was developed by the 3 credit bureaus in 2006, okay? But both of them, whether it be FICO or Vantage score, they both have the same credit score range. Now, they don't weigh the different factors the same, but in terms of the range from 300 to 850, they both have the same range. FICO has 5 categories, whereas Vantage score, on the other hand, has 6 categories. And the thing with Vantage, not only do they have a range from 300 to 850, they also give it a grade, a letter grade. Each range that they provide, they actually apply a score to it. So you feel like you're in school reading your credit report because it provides you with a B. You are an A student, a B student, C student, or an F student, okay, based on your credit score. Okay, let's start off with FICO. With FICO, 35% of our score consists of our payment history, okay? So if you're consistently making payments, then chances are you will have a very, well, I won't say a very high score, but you'll have a good score. 30% is actually credit utilization. How much of your revolving credit that you have used, okay? When we talk about credit limits and we talk about the amount of that credit limit that you have used, 30% of your score actually accounts for that. 15% is the length of history. How long have you had credit, okay? Did you just start having credit last year, or was it 10 years ago? If you have credit, if you started building credit 10 years ago, chances are it will have boosted your credit score. So normally when I'm talking to students, I say, make sure that you are aiming to have a good credit, because if you're just, and the reason I say good is because a lot of students are just now starting to build credit. So to have great credit around 800, 850, 15% of that score would have to account for your history, okay? So good credit right now, if you're just starting off, is what you will be aiming for. And as you progress in years, then you will actually move on to great credit. 10% is actually new credit, and that means how often have you applied for credit? Do you apply for credit often? Let's say, for example, you apply for a credit card now, and then 2 months later, you apply for another credit card. That doesn't look too good. But if you apply for a credit card now, but you apply for a car loan later on, remember I said in the previous lesson, credits, when you have different types of credit, it actually builds your score. And as you can see here, the last category is your credit mix. There are actually 2 main categories that the scoring systems look at, and that is revolving and installment credit, okay? Now let's talk about Vantage score. Vantage score, as you can see, payment history accounts for 40% of the score, okay? 40% of the score, whereas FICO accounts payment history for, applies 35% to the payment history. Depth of credit actually means how long you've had the credit and the type of credit that you have. So with Vantage score, they combine the two, the length of credit and the type of credit, okay? So that equals 21% of your score. 20% is how much of the credit that you've used, and that's the credit utilization for Vantage, whereas for FICO, that's 30%. 11% is your balance, and 5% are the inquiries, and then whereas for FICO, it's 10%, 3% available credit. How much credit do you have available to you, okay? Now, here is the scoring range. If you pull a copy of your credit report and you fall within these categories, then this is what you can expect if you were to apply for credit from a lender. Okay, so if your score is, let's say, between 670 and 739, you're considered a good borrower. Okay, so you're considered a credible borrower, and pretty much a lot of lenders will extend credit to you. Now, if you're 740, 799, you start getting into the category where you can actually negotiate some of your rates. okay? Because you're considered a responsible lender, a very good responsible borrower, and also a very, very good borrower. You keep your credit balances low, and you also make payments on time, okay? And 800, once you hit the 800 mark, consider yourself to have arrived, okay? Because a lot of individuals, especially in our economy right now, that is not a range that a lot of individuals have, a lot of consumers have, okay? So you are receiving the best rates from lenders. And usually the higher your credit score, the more credit card solicitations you will get in the mail. So if you're in the process of repairing your credit and you won't see that many solicitations. But as your credit score starts building up and the higher you get to the 700s, you will receive a lot more credit card solicitations. Okay, now let's look at Vantage score. Remember I said Vantage score uses the credit card method, okay? Now, if you look here for Vantage score, a score between 300 and 600 is considered an F. And if we go back, FICO score 300 and 579 is considered very poor, okay? So their credit range differs a little. And for exceptional credit score, if you look at FICO again, you have to have an 800 to be considered exceptional, okay? Whereas Vantage, on the other hand, a little more leniency with them, 790 is considered to be exceptional, okay? And right here, you can actually see that your score as a consumer. So are you an A consumer, a C consumer, or an F consumer, okay, based on your credit score? Okay, now let's talk about some of the factors that actually affect our credit score, okay? And some of them we may not even think of, and some of them we may be thinking that we are a responsible borrower, but by taking certain steps, but in reality, it's really affecting our credit score. Okay, what actually impacts us negatively? First, closing paid off accounts, okay? When we close paid off accounts, one of the things that we will see is for some individuals, the credit score will actually drop. And those are usually installment loans. Installment loans, the way it works is when you have a credit, when you have a loan, let's say a car loan, with that type of loan, you normally make payments until it's paid off. Once it's paid off, the lender will actually close your account. Now, with a revolving credit, on the other hand, the way that works is you have a credit limit, you can use some of that amount, pay it off, and then you're back to the starting point. For example, if you have a credit card of $1,000 and the limit is $1,000, you use 200. That means you have 800 left. But if you pay the 200, then that means you're back to 1,000, okay? So with an installment loan, as soon as that payment that loan is paid off, then your account is closed and you're borrowing the date that is on your credit report as of the date that you borrowed that loan. If that is your only form of credit, remember 15% of your credit score accounts for the length of history. So if your car loan was the only loan that you have on your credit report, 6 months later, it will actually be considered a stale file, or you will be considered a credit retired consumer. Okay, so it's always good to have your credit open, and even if you only pay $5 a month, or use your credit let's say you have a credit card, use your credit card every 6 months. You don't have to maintain a balance every month, but just have something on your credit something to keep your credit active, okay? Oops, I'm going backwards here, sorry about that. Okay, let's talk about high credit utilization. High credit utilization is something that I will actually break down in the next few slides. And that is where you have credit limit and you're using most of your credit limit. And the thing is, a lot of individuals don't realize if they use 30% of their credit limit, it automatically causes their credit score to drop. So it's always good. I always advise individuals to keep their credit utilization within the single digits. If it moves into the 10%, 15%, then it's not all bad. But if you move into 30%, expect your credit score to automatically drop. Okay. Applying for credit too often, I talked about that. If you're applying, especially for revolving credit cards. If you apply for credit, too many credit cards too often, it's one thing if you apply for a credit card today and then maybe a year later or 9 months later, you apply for another credit card, that's not too bad. But if you're constantly applying for credit cards, then you're viewed as someone who may potentially be having financial challenges. Now, as I mentioned, the type of credit that you're applying for makes a difference. It's good to have installment credit because it shows that you are building assets. Revolving credit actually helps you maintain a longer credit history. Okay, so if you can think of it this way, installment credit helps you actually build assets and is viewed upon favorably by the credit reporting agencies as something positive. Credit cards, which are revolving credit, helps you build a longer credit history. Okay? Credit profile is not diverse. So that it basically means what I just said. If you only have credit cards, it's not viewed favorably. If you have a diversification of credit, which is installment and revolving, then it makes you a more diverse borrower. Now, here are the areas, and I kind of went into these, the 3 areas that are not easily understood. Credit utilization, if you use 30%, I've said that already, if you use 30% or more of your credit limit, and that is for revolving credit, if you use 30% or more, then your score automatically drops. If you apply for too much credit too soon, then your credit score will drop. Not too much because it's only 10%. And credit mix, if you don't have a diversification of credit, then your score will not drop so much, but it will not increase. And it affects your score by 10%. Okay, now in terms of credit utilization, as I mentioned, that is one of the parts, part of credit that a lot of individuals do not understand, because it looks at credit utilization in 2 parts. First, individual credit cards, as well as the total credit cards. What I mean by total credit utilization is if you have 4 credit cards, what is the total limit on all 4 credit cards and how much of the limit for all the 4 credit cards have you used? Okay, so it looks at each credit card individually, and it also looks at your total revolving credit as well. Okay. Okay, here's a breakdown right here. Let's say, for example, for individual credit card, you have a $5,000 credit limit and you only use $1,250. My math is wrong right here. For those of you who are mathematicians, you probably caught that. But you only use $1,250. The amount that you would have used would not have been 30%. Okay, so if it's not 30%, your score will not drop at all. Okay, so if you use 30% or more, then your score will automatically drop. Oops, sorry about that. Okay, now credit utilization here. This is what you will see. Credit utilization right here, 10% means that this is what lenders consider. 10% is considered great, okay? 15%, you're still doing good. 20%, then lenders will start thinking, okay, something may be a bit challenging for this individual. 30%, the lender will automatically consider you to have some challenges when it comes to finances, okay? And that is when I said your score will automatically drop. Okay, now let's take a look at the total credit cards. Let's say you have 3 credit cards, okay? You have a MasterCard, Discover, and Visa. So for each of them, $5,000 is your credit limit. For your MasterCard, you use $250, so that leaves you with a balance of $4,750. For your Discover, you use $500, so that gives you $4,500. Your Visa, $1,000, and that leaves you with an available credit of $4,000. So when you add everything up, your balance due is $1,750, and if you divide that by 15,000, which is your credit limit, that gives you a total credit utilization of 12%. And as I mentioned, whenever you use a credit utilization of under 30%, what happens is you are considered to be okay. The lower it is at 10% or 12% for this example, chances are a lender will look at you and think, okay, this person is okay to lend. I'm not sure what is going on here. Okay, credit mix. Now your credit mix, on the other hand, accounts for 10% of your score. Okay, now remember I said revolving credit is credit cards. Credit cards help you build your length of history. Your installment credit, on the other hand, is what helps you build assets and what is considered to be favorable for you. Okay? Now, there are 4 types of accounts that you will see on a credit report. I will have all of them listed for you right now. Revolving credit is the first one, and we talked about that, and that is credit cards. Installment accounts, car loan is an example, and then service accounts and also considered to be open accounts are utilities. Utilities you will not see on your credit report, as I mentioned earlier, because they are not considered something that you have actually applied for credit for, okay? The only time you will see utilities on your credit report is when you have defaulted on your credit report, on your payment, okay? So if payments are usually made on time and you haven't defaulted at all, you will not see AEP, you will not see your water company on your credit report. Now, charge cards, on the other hand, are another type. Charge cards are the type where usually individuals who qualify for those are individuals with high incomes, okay? And there is no credit limit, so they can borrow as much as they can on a charge card. And the catch about charge card is payments must be paid in full, okay? So because payments are expected to be paid in full, then the interest charge is usually 0. So there really is no interest charge on charge cards at all, okay? Because payment must be made in full, and it's usually extended to individuals with a high income and normally those individuals work for organizations that allow them to have charge cards. Okay. Now, we mentioned hard and soft inquiries. Hard inquiries are the ones that the lenders make. Whenever you sign on the dotted line, then a lender will actually pull a copy of your credit report, and that affects your credit score. Okay, so if you apply for a credit card, then you will actually see that, let's say, for example, Discover, you apply for a Discover card, then you will actually see that on your credit report. Now, for soft credit inquiries, what that means is I have actually applied for, not so much applied, but I have actually decided I want to see what is on my credit report. So if I go ahead and pull a copy of my credit report, then I will see that it is not listed as something that will affect my score. So if you were to apply for, or I keep saying the word apply, but if you were to pull a copy of your credit report, you will not see it on your, as a factor that is affecting your credit report, your credit score. But if a lender, on the other hand, does that, or if you apply for an apartment, or if you apply for employment, all of that will actually affect your credit score. So hard inquiries is usually when you sign on the dotted line and say, I would like to utilize your service, or I would like to borrow money. Then that is considered a hard inquiry. If you yourself or I say, I want to pull a copy of my own credit report, then it will not be reflected on our credit score. Okay, so what have we covered? First, we defined credit report. Then we actually defined who can actually access our credit report. And then we talked about how you yourself and I can access our credit report, as well as we reviewed credit scores and factors that affect our credit score. Now, if there are any questions, please feel free to let me know. I know I covered quite a bit, so if you have any questions at all, feel free. You can ask me now, or we can go ahead and touch base later. And I can be reached at TU Financial Wellness. If you do not have any questions now, but later you think, oh, wait a minute, this is something that came up after the presentation, then feel free to go ahead and let me know. Okay. Our next webinar will be next Thursday, and the topic we will be covering is building credit. Finally, if there are no questions, please go ahead and complete our survey. That way, I'll know exactly the areas that I need improvement, or even information that you would like to see for the next webinar. We have several more webinars that will be taking place. So feel free, let me know in the survey what areas that you would like covered, and how you believe this webinar has actually gone for you. If it answered your questions, if there are more questions after viewing the presentation that were not answered, or you felt should have been answered, that is good to know as well. Okay, so if there are no more questions, then I will go ahead and end our presentation.